right, so we are live and recording now for this next series in our next webinar in our series, if you will, called Explaining Capital Stack Structures and Apartment Syndication. And we're going to be talking about lots of different things today, and I'm really excited to share it with you because this is a topic that I really love talking about. And so I will definitely be spending some time here. Planning to spend about 20-25 minutes going over some of the material. Then I'll open it up for some questions and answers throughout. So if you have some of those questions, feel free to type them into the chat box, and we will get to those towards the end here. So a couple of things I want to mention before we jump in. My name is Dan Handford. I'm one of the managing partners of this group right here that you can see on your screen called PassiveInvesting.com. You can find out more information about us by going to PassiveInvesting.com, and you can also click on this little Meet the Teams link here. And in this Meet the Team link, you can see, of course, my picture here along with the other managing partners. You can click on that link and find out more information about me and my family. I do live here and reside in Newark and Columbia, South Carolina. I'm married, have 4 children, 3 girls and a boy, and a little dog named Bella. I say little, it's a standard poodle, but you can find out more information there. Instead of spending the time going over my background and stuff like that, you can just go head over to PassiveInvesting.com to find out more information about it. If you want some more information about our current offerings and you're interested in possibly investing with us, you can click on this little button here, this little link here, and you'll see a little drop down for some of the, we have this Las Palmas Apartments is an offering that we have available, our self-storage fund, and also our real estate debt funds. You can find out more information about each one of those as we go throughout. So the last thing I want to mention to you is about this MFIN Summit. We have a summit coming up in a couple of weeks, actually 2.5 weeks from today. It's called the MFIN Summit, the Multifamily Investor Nation Summit. It's an all online, live 3-day online event for just multifamily investors. So if you're interested, go here, find out more information. It's January 20th, 21st, and 22nd. And if for some reason you go here, or you're watching this as a recording and it's past these dates, you can obviously go and actually watch these. You can't watch the recordings, but you can actually go to the MFINSummit.com to find out more information about some future events that will be happening around multifamily investing. So feel free to go there as well. You'll see the full speaker lineup. I won't spend too much time on this because I know you guys can go do your own research on this, but this is a great event. This is not something that we just started. We've been doing this for several years now. And we know a thing or two about running some of these virtual events. So go to MFINSummit.com and find out more information about this. And without further ado, let's talk about explaining capital stack structures in apartment syndication. So what I'm going to do today, because I know for those of you who have watched any of our webinars or followed me at any point in time, you've noticed that what we typically do is we typically have no PowerPoint. We basically just kind of talk and go over various things. And so today I'm going to do the same thing, but I'm going to share with you. I have this little electronic whiteboard behind me. I'm actually going to turn my video off during this part of it because it's kind of weird to walk around on my headset and stuff like that. So I'm going to turn my video off right now, but I'm going to share with you on my screen this whiteboard so that you can actually see exactly what I am seeing here and what I'm drawing on. So I'm going to put a big old circle here just to make sure that you guys can see this okay. So if you guys can see that, just raise your hand in the box there, if you will, just make sure. All right, good. So everybody can see that. So what I'm going to do is I'm going to kind of turn my screen just a little bit so I can have a little easier time drawing on it here. But what I like to do first is go over the capital stack itself, because a lot of times when we talk about capital stack or you hear other people talking about the capital stack, there's a little bit of confusion as to how it's actually set up. But it's very simple, okay? So let's first, and as we're doing this, something that would help you to kind of learn and pick this stuff up is for you to get out a piece of paper and actually start to draw these things out alongside me while I'm doing this. That's how you're going to be able to cement this information a little bit further. So what I'd like you to first do is just draw a big stack. This is what I'm going to call a stack on your piece of paper that looks just like this. Okay, so this is going to be the first thing we're going to go over today. This is going to be the capital stack, we're just going to have this called like a general capital stack, and then we're going to go over a couple of different things today. We're going to go over some priority positions of where these different positions in the capital stack have precedence or priority over another position in the capital stack, And then we're also going to talk about the risk involved in each position in the capital stack. And then we're going to break it down and go into what was the difference between a two-tier or a single-tier capital stack, so you can have a better understanding as to what each one of these things are. So first off, we're going to go over this kind of general topic around what a capital stack is and what it looks like. So typically what you're going to see in the biggest portion of the capital stack is going to be your debt, right? Even let me just step back for just a moment and actually talk about one more thing before you kind of go over into the different positions in the capital stack. So obviously when I was growing up, but also I have kids now, and when we sit down and play and build Legos, we build them from the ground up, right? We don't build them from the top down. So when you think about a capital stack, you always build it from the ground up. So we're going to talk about things from building it from the bottom up. And so as we need to buy a property, let's say there's a $10 million property that we want to buy, we have to be able to somehow figure out the capital stack of how we're going to take down that property. And usually the largest investor in the property is going to be the lender, the debt, right? And so you're going to see a large majority of this is going to be the debt component of it, right? They're the largest investor. Okay. Now they're also the ones that get the least amount of return. And I could probably move this a little bit here. This is probably a little bit, excuse me, I just dropped my excuse me, electronic pencil here. Probably move this a little bit higher because that looks like more like it's a 50% piece. It's really more probably like 65 to 70%, maybe 75%, upwards to 80%, right? Majority of the capital stack is going to be this debt component. That's the majority of the capital stack. Okay. And so the return off of this is usually going to be, right now we're seeing, 2.5 to say maybe 4.5% interest, depending on the size of the deal, where it's located, the market, the asset class, various things like that's going to determine what the interest rate is, right? So the return to this investor is going to be 2.5 to 4.5%. Now, let's add on another piece here. So typically there'll be another slice in here, which we might call our preferred equity slice. Okay, this is going to be preferred equity, and preferred equity is going to get a little bit more than that because they're going to only be about maybe say 10 to 25% of the capital stack. And so that preferred equity slice might get anywhere between 7 to let's call it 10%, somewhere around in there. Okay, and then and not all deals have preferred equity, but I'm just sharing with you in general what some of these different capital stack pieces could look like. And then you're going to have another piece in here, which is going to be your common equity. Okay, this is going to be where your investors might sit, and then of course you're also going to have your GP equity. All right, so your GP equity is going to be up here. This isn't exactly to scale because I'm drawing this, so just bear with me here. But your common equity, of course, that might be anywhere between 15 to 20%. All right, depending on I'm talking about overall return. So 7 to 10 for preferred equity, common equity, 15 to 20. And of course, your preferred equity is really a question mark here because you're not actually most GPs are not putting equity into the deal as on the GP side. They're putting it on the LP side right here in along with investors. They're going to get that kind of, for their money that they're putting in, they're going to get that 15 to 20%. Okay, so this is a general kind of overview of what it looks like. So you're going to first have some sort of debt component. You might have a preferred equity slice, and of course it's going to be your syndication slice, which is going to be the combination of your preferred equity, your GP equity and your common equity that you see here. Now, as we're going through this, let's kind of talk a little bit about risk. Okay, so if we look at this, one of the things that you can look at as far as risk is concerned is you can say, okay, how is the risk based on how is the risk when it comes to return levels, right? So one of the things we always think about when it comes to returns is that you have a higher return. Okay, a high return usually is going to equal a high risk, right? And then the opposite of that, a lower risk or a lower return is going to mean lower risk. Okay, and that actually works out the same way when it comes to this capital stack structure here as well. Okay, and you can see that because the lower return is going to have a lower risk. The higher return is going to have the higher risk, right? And so this is important for whenever you get to, this is really important when you start to get into different, like a dual tier investment structure, which we're going to go over in just a minute here, but it gets really important when it comes to that because as an LP, as a limited partner, a passive investor, you want to know where you sit in the capital stack so you know where your risk is, right? So you kind of know what's actually at play here. So let's kind of think about this for just a moment. And before we move on from this, we talked about down the lower in the capital stack you are, the lower the risk you have, right? So risk actually goes down as you go down the capital stack, and of course it goes up as you go up in the capital stack structure. The same thing happens when it comes to the return, right? And then of course, seniority position works the same way. So the lower you are in the capital stack, the higher seniority position. What I mean by that is that as the property has cash flows that comes in, the debt payment's going to get paid first, then your preferred equity, then your common equity, and then if anything's left over, the GP equity gets up, right? Or the GP shares, if you will. So really, I say preferred equity slices and things like that in there, but these are really common equity shares, preferred equity shares, and GP shares, if you will, to make that a little more consistent. So this is kind of a general capital stack structure, if you will. And so let's actually go over what a capital stack structure looks like in a single tier investment that you would most commonly see inside of the multifamily investments. So let's just change this color a little bit here. Hopefully you guys can see this. So we're going to, again, draw our capital stack here. And again, this is going to be a single tier capital stack. Okay. So the first thing, what's the first thing we're going to have down here at the bottom? This is going to be our debt. So again, the debt's going to be the largest piece. This is going to be our lender. And then you're going to have, again, this is going to usually equate to a 70-30 split. So 70% of this deal is owned by the LPs, and then 30% is owned by the GPs, right? So the LPs, this is a single tier, is going to be this LP shares, right? And this is going to be common equity. Common equity shares. These common equity shares are what's going to be for your limited partners or for you as a passive investor, if that's what you're looking at here. This 30% is just the GP, the active deal operator or whatever, and that's what those shares are going to be for. Okay. And so again, as you look at this is a pretty basic kind of single tier, if you will, a capital stack structure where you have the debt here at the bottom, and then you have your common equity shares, and then you have your GP shares. Well, the reason why this is also important is you as an active investor, if you're putting together and structuring deals for your investors, you want to make sure that you structure them and set them up so that your investors see the success, right? Because at the end of the day, if you don't have investors, you can't buy more deals. And you want to be able to keep your investors happy. So this is one way to set them up for success. And so what happens here, in order to fully understand the capital stack, you kind of have to understand a little bit about a waterfall. So let's talk about that for just a moment. So a waterfall is basically telling you where the money and the cash flow is going to go. And think of it like little buckets, right? Think about little buckets that are happening here. And so this is kind of what we would call a cash flow waterfall, where the money that's coming in goes into the first bucket, and it continues to fill up this bucket until it can fill up no more, and then it spills over into the next bucket. And this one does the same thing. The cash flow goes into there and spills over to the next bucket until it fills up, right? Until it can't fill up anymore. And so this first bucket, let's call this a preferred return bucket. So this is maybe say a 7% preferred return. And in this 7% preferred return bucket here, 100% of the cash flows. So here we're going to say 100% of the cash flows go into this bucket until you reach this 7% preferred return. And once you reach that 7% preferred return, it spills over to the next bucket. And this bucket might be where the equity splits 70-30. Okay, so 70% is going to go to the LPs and 30% is going to go to the GPs. And then once this fills up to a certain hurdle, which that hurdle, that hurdle up here might be let's just call it a 13 IRR, right? Once you get to a 13 IRR, then the cash flow spins over to this next bucket down here. And this bucket might be a 50-50 bucket spread, right? So this is basically going to be combining a little bit of what you see here in the capital stack into a waterfall. Now, what we're not accounting for here is like the debt payments or anything like that. However, but this is more what they call a cash flow waterfall. So whatever cash flow is available after the debt has been paid, what happens to that cash? Okay. And of course, you can also have what's called instead of a cash flow waterfall like we see here, you can also have what's called a kind of a capital event waterfall, which I won't go over that in too much detail, but it works the same way, where the capital that comes in when you sell an asset, the first thing it's going to do is going to pay off your debt, and then it's going to return the initial equity back to your investors. Then it's going to go to any lagging preferred returns, and then it's going to give 70-30 splits up to a 13 IRR, and then it's going to go 50-50 after that 13 IRR. And so you might have multiple buckets that'll be built out here to kind of go over that kind of waterfall structure, if you will, with that capital stack. Okay. All right. So this is the single tier capital stack. Now let's go over the dual tier capital stack structure here just a moment. So let's again go back to our kind of capital stack here. Okay, a little messy here. Let me actually correct that a little bit because it's going to drive my OCD off the walls. So I'll fix that a little bit here. All right, that's a little bit better. And this is going to be a dual tier equity structure or capital stack structure. Okay. And so the dual tier capital stack is going to, again, first thing that's going to be in here is our largest investor. This is going to be the debt. The debt's always the largest investor. It's always the lowest return. It also has the lowest risk, but the highest priority in the capital stack. So the higher the priority you have in the capital stack, the lower the risk and the lower the return. So right next to the debt in a dual tier investment structure is, we're going to show here, we're going to have let's just call this a Class A share. Okay, Class A shares. And then right above that, you're going to have Class B shares. Ooh, sorry about that. And then, of course, you're going to have Class C shares up here, which are Class C shares are going to be, it's very similar to what we saw over here. I'm just labeling it just a little bit different. So, over here, this one might have been, a Class A share, because it's only a single tier, and then this one would be Class B, right? So it's very similar. And of course, as you saw it here, it'd be the same thing. This would be your Class A, this would be your Class B, and this could be your Class C shares, okay? I'm just labeling this just a little bit differently so you guys can kind of see some of the nomenclature a little bit differently in different areas. So what we're seeing here is that Class A has a lower position in the capital stack. So that means it has a higher priority over A has a higher priority over B, and B has a higher priority over C, okay? And so typically what you're going to see is you're going to see this Class A share is going to be anywhere between about 10 to, I'll probably say 35% of the capital stack. So if you're raising $10 million, this might be anywhere between $1 to $3.5 million of that 10 million that you're trying to raise, right? This is outside of the debt. This is just the equity portion that we're trying to raise to be able to close the deal. And then the rest of it's going to be this Class B share. Now the Class A share is a kind of a faux it's not a faux, but it's a preferred equity slice, preferred equity. And typically going to be, you know, say like, let's just call it 9% return, 9% pref, right? So what's going to happen here in the waterfall is that 100% of the cash flows are going to go to this investor first to reach that 9% preferred return before it goes over here to the Class B investors. Okay, and the Class B investors is going to be the remaining portion of the capital stack, and it might have a 7% pref. Okay, but the difference is that the Class A provider has no upside. There's no upside potential for this person. So they're basically giving up the upside to get the higher pref, because they have a lower position in the capital stack, they have a higher priority, which makes it a lower risk investment for them. So they are pretty much guaranteed to get this 9%. I say pretty much because we can't obviously guarantee things, but unless the deal just goes completely south and nobody gets their money back, and then Class B doesn't get any of their return, Class A is going to get that 9%. So a lot of investors like that because they like that safety net, that security of that Class A share where they get that preferred return of 9%, and it's as close to a guarantee as you can get. And then of course you have the 7% preferred return here in the Class B shares, and this one's going to have upside potential. So they might, after that 7% preferred return, like we talked about in the other example, might get a 70-30 split up to a certain IRR. Let's call this a 13 IRR over here, and then it's going to split 50-50 once the property is outperforming, right? And then of course your Class C shares are going to be just your GP equity, and of course they're going to get their slices from the different equity pieces from here, as you can see in the example from the 70-30 and the 50-50. Okay. That's the difference. That's the difference between a single tier and a dual tier investment structure. So I want to open it up now for some questions and answers so that you can have the opportunity to ask me about some of these capital stack structures. So we went over the different components of the different seniority positions of where you might be in a capital stack. We went over which positions in the capital stack have the most risk. And then we also went over kind of a dual tier and a single tier equity structure. And then as a bonus, we kind of threw in there a little bit more about waterfalls. Okay. So I have Aman ask me here, can you explain again a little bit about Class B shares? So the Class B shareholder is going to be very similar to your shareholder over here. So it's going to be this kind of common equity shareholder that you see here. The only difference is that we have now added in another slice here, which is going to be this other slice that you see right in here. So we've added in this slice, which is your Class A shareholders. And what the Class A shareholders, the benefit of Class A shareholders to the Class B shareholders is that the more Class A that you have, the higher the overall IRR or annualized return for the Class B investors. And the reason why is because they're giving up any upside potential. So if you take away more money or more equity from Class B and you move it to Class B and you move it to, I didn't know it was going to do that, you move it to Class B over Class A over here, then it's going to allow you to have a higher IRR and a higher annualized return for your Class B holders. Now, at the same time, what it's going to do is it's going to reduce your overall cash on cash to the Class B investors. Because if you're giving more of a return to these Class B and Class A investors, then your Class B return is going to go down. Okay, not necessarily the pref. The pref isn't necessarily going to go down, but it's going to be the year over year cash flows that might go down. And hopefully, if you're putting together your structure, putting together your deals properly, like we do things, you're going to have the protection for your investors where you have a cumulative preferred return that is actually built up inside of there as well. Okay. All right. So a couple of questions in here. Can you explain return of capital versus return on capital? So yes, that's actually a good question. There's two different nuances here between return of capital versus return on capital. So the real important piece here is that's can sometimes get missed by investors is when you think about this return of versus on, it's really only one letter different, right? On versus off. Well, when you're an investor as an LP, you really want to be looking at operators and deals that give you monthly distributions or quarterly. I prefer monthly. Our group always does monthly, but at least quarterly distributions that are given out as a return on your capital instead of return of your capital. And the reason why is because the way you calculate a preferred return is it's based off of the unreturned capital contributions of a deal. So the more return of capital you have, the lower your overall return is going to be, because you're constantly lowering your unreturned capital, if you will. So if you start with 100,000 and you got 7,000 that year, now your preferred return is going to be based off of 93,000 instead of 100,000. Now, those operators do that because the more they can give you back of your returned capital, the closer they're going to get to these different equity splits over here. So it only benefits the operator, not the passive investor. So you have to be careful as a passive investor to make sure that you're watching for those different words versus this return of versus return on. And these operators that do this will tell you that it's better because you don't have to pay any taxes, because we're going to do it as return of capital instead of return on capital. But what they aren't thinking about is that, or maybe they are thinking about this, but they're hoping you don't think about it, is the fact that whether I get it with return of capital or on capital, I'm always going to get a negative K1 because of depreciation, right? I'm going to get this depreciation benefit, and whether it's return of capital versus return on capital, there's going to still be recapture in the end when we sell if we don't 1031 exchange. And so the only benefit for somebody to do a return of capital versus return on capital is to allow that operator to hit their hurdles faster, rather than later on in the deal itself. So good question there. The dual tier, can you draw out the waterfall like you did with the first example? Give me just a moment, John. Let me go through some of these other questions, and if we have some time, I'll definitely try to go through that with you. The preferred returns are consistent with what I've seen. However, with recent inflation, 7 to 9% doesn't seem that high. Are you anticipating an adjustment? I don't necessarily think that we're going to see an adjustment in this preferred return. I think what you might actually see is it actually go in the opposite direction. I've already started to see some deals lately that have had 5 and 6% preferred returns instead of the 7 to 9%. And I've seen some people just do away with preferred returns altogether, and it's just a straight split. But when it comes to inflation, obviously with inflation, we're able to increase the rents and have a great rent growth, which is what we've been seeing over the last year, which will allow us to be able to capitalize on some of those higher cash flows to allow us to even achieve the 7 to 9% preferred returns. But I don't necessarily think it's going to go any higher, but I definitely do think that it could potentially go lower because some of these assets are getting tighter and tighter. But it's not necessarily that the preferred return would go down, but the overall return for the deal. Because for me as an investor, for me as an active operator, if I change my preferred return from 7% to 6%, the only thing that does is allow me to hit my return faster, or me to get a higher return from as an operator versus the investors. So it's not necessarily that correlated that easily with inflation like that. All right, for a $20 million deal, do you recommend a minimum amount of investment from shareholders? Well, it really depends. It depends on how much debt you can actually get on the property, whether it's 60%, 70%, 80%, whatever it is. And it's really dependent upon how much equity you could bring, how much equity you need to bring to the table. So it's not necessarily a question of, hey, I want to buy a $20 million deal. What's the minimum amount of an investment? It's really what's the best kind of debt you can get for that particular asset in that class and that investment play. And then what's available, what do you need to be able to acquire that asset? So I don't think the question you're asking is really a very valid question until you actually know what deal you actually have. Where would the mezzanine fall in the capital stack? So the mezzanine would actually fall right above the debt. So you'd have the mezzanine debt, mezzanine debt is very similar to preferred equity. It's just called preferred equity instead of preferred debt, right? But mezzanine is very similar to kind of a preferred debt where you have the primary lender, and then right on top of it, you're going to have another lender, which is going to be that mezzanine debt. And then you're going to also have the capital stacks above that as well. So it definitely sits in there right next to the lender at the bottom of the capital stack. How soon do you intend to pay out LPs? Now the question here is when do I intend to pay out the LPs? But you mean as far as giving them starting distributions, or are you asking about when am I going to return their capital? So as far as distributions are concerned, we're going to give distributions to our LPs as soon as we can. So typically the assets that we're buying, we're acquiring assets that will allow us to pay out our LPs monthly distributions after we've been into the deal for a full month. So there's been deals that we closed in November. We'll wait to have the full month of December of operations, and then we're going to be starting distributions this month for those investors. Now, when it comes to returning their capital, obviously that depends upon whether or not we're going to be doing refinances throughout the deal, or whether we're going to be doing not just refinances, but going to be doing a sale of that asset and returning some of that capital to investors. So it just depends on the play there. How is asset liquidation handled? So the asset liquidation is handled based on those waterfalls, right? We talked about the differences in the different waterfalls, right? We talked about a cash flow waterfall, then we talked about a disposition or a capital event waterfall. And so there's going to be two different waterfalls that you'll always want to make sure you look at when you're putting together these types of deals, or whenever you're reviewing these types of deals for passive investments. Do you focus on wholesale properties with deferred maintenance, or focus on newer properties? We primarily focus on newer properties. So we're going to be B+ with some light to moderate value add, and then also some of the suburban Class A assets. For your LPs, do you only work with accredited investors or non-accredited investors as well? So right now, we're primarily working with accredited investors. So we are working on potentially launching a Regulation A fund later this year. We have a couple of things in the works with that, but nothing has been finalized just yet. So that would be something that would allow us to be able to accept non-accredited investors. But right now, most of our offerings are going to be for accredited investors only. What happens when cash flow goes negative? Same thing happens when cash flow goes negative, is that you're going to look back at the operating agreement and figure out who actually has to pony up. And so that would be what we would call a capital call. And so a capital call is going to be very clearly defined, and it's not necessarily has anything to do with the waterfalls as much. The waterfalls are really with it when it has to do with the incoming cash flows or the positive cash flows. When it comes to negative cash flows, where you have to put money back into the deal, then you're going to have to look at the operating agreement and figure out where how it is actually structured and set up there. All right, so a few more questions in there. Is the waterfall also referred to as the liquidation preference? So the waterfall, which would be the capital event waterfall, yes, it would be a liquidation preference, but also what would be called a liquidation waterfall or a capital event waterfall. Do investors often sit within multiple classes to further diversify and hedge their risk? Great question, Paul. The answer to that question is yes. And we encourage investors to do that, because you can now have this you have a blended risk profile within the same investment, where you have different opportunities to invest in different classes. So now you have this kind of blended return, if you will, amongst those various classes, share classes. Do you raise extra money from investors to account for monthly distributions? Some groups make you wait 6 months to get your first distribution. I was curious why. So some months do wait because they don't necessarily capitalize their group from the very beginning, and they don't want to be distributing the initial cash flows off of an investment because their deals are undercapitalized. So to answer your question, Jason, yes, we always raise extra money into the deal. So we usually have anywhere between 4 to 6 months of operating reserves, where if the property went down to 0% occupancy, we could continue to pay for the debt service and the expenses for up to 4 to 6 months into the deal. And sometimes, depending on the size of the deal, it could be several $1 million. So anywhere between $1 to $3 million of extra operating reserves to have that safety net there, so that we don't have to worry about any type of future capital calls in the future. Is pari passu relevant to this discussion? So the pari passu is relevant to the discussion around preferred returns, and whether or not they are true preferred returns, or what we call a preferred return with a GP catch-up. And I won't go into too much detail because I know we're running out of time here. It's already 11:40. But we did do some webinars. I have done a couple of webinars on this particular topic. And I tell you what, actually, I did an article on the red flags for passive investing recently. And let me see if I can find that article for you and post it, because that article is a great article for you to review. And it actually goes over what you're talking about right now with the preferred returns with catch-up and without. So if you go to passiveinvesting.com, and on the top right-hand corner of the screen, you'll see where it says Knowledge Center. Just click on Knowledge Center, and you will see a thing there that says red flags for passive real estate investing. But for those of you who are watching this live, I'm going to just type this into the chat box so you can have this. But this right here is the link to that article, and you'll see red flag number 4, which goes over the preferred returns and the preferred returns with catch-up, and that's where that pari passu really comes into play here. All right. Are investors allowed to make cash calls prior to predetermined payment points, for example, quarterly or monthly? And if they can make a cash call, are they penalized? So I've never heard of anybody having an opportunity for investors to say, hey, I want my cash back, unless it's in some sort of a fund that has cash that's coming in and out of the fund, and they give them that as an opportunity. So, for example, our real estate debt fund that we have does have this kind of an option where investors can invest in it, they can put their money in, and they can ask for all or a portion of their money back, and they will give it to them within a 90-day period of time. So there are opportunities for things like that, but it's not necessarily, I've never really seen it inside of a multifamily asset like this either. Will the monthly or quarterly payouts be based on preferred or common status? The monthly and quarterly payouts are always based off the preferred return. And the preferred return is based off of the unreturned capital contributions in a deal, right? And so if your preferred return is 7% and your unreturned capital is 100,000, then you're going to get you should be getting paid 7% divided by 12. So 7,000 divided by 12, that should be your preferred status, or your return status. And it's going to be different depending on the share class, because you might have a common equity shareholder that's only getting 7% preferred return, and a preferred equity shareholder who's getting a 9% preferred return. So those amounts will vary based on each one. What was the cash flow situation in COVID where tenants moving out and others not paying rent? So it's a lot of it was dependent upon how well the assets were performing, of course, during COVID, with those different on how well they were trying to get the rent payments paid back for some of the local government assistance that was available. I will say that our portfolio did not see as much of an impact with COVID as I know some of these other portfolios that I've been watching in the past, because our portfolio is primarily a newer asset class, which have residents that aren't having as much of an issue making rent payments. And with the lower end assets where people were losing their jobs a lot more were the ones that suffered the most. And I know several situations where, because the tenants were not paying and they were moving out, and there were others that just couldn't make their rent payments, because of COVID, they had to do capital calls with their investors to keep their rent payments up and to be able to keep paying for their expenses and their debt service. So albeit it was short term and short lived, but some of these assets I think that had some government assistance are going to start showing up here in 2022 as some good opportunities to buy as well. All right, so it looks like we have a couple of the questions in here. I know we're running out of time right here, so I'm going to stop right now answering any more questions and just tell you thank you for being a part of this webinar today. It's been great being here with you. Looking forward to sharing with you next week. We actually have Brandon Abbott, one of our other managing partners, who's going to be with you talking about submitting an LOI for apartment syndication, some of the behind the scenes there of what it looks like in submitting an LOI. So Brandon Abbott will be talking about that next week at his webinar. And so make sure you do that. And also don't forget, go register for the MFIN Summit. Go to mfinsummit.com. Looking forward to having you there at the summit. It's coming up in about 2.5 weeks. So go register, buy your ticket now, lock it in. We look forward to seeing you here in a couple of weeks at the MFIN Summit, and also next week for the next webinar.